All right, let's start with a financial puzzle that honestly should be impossible. It's a story about a hidden trap that can completely wreck even the best-laid retirement plans.
So meet Alice and Bob. If you looked at their plans, you'd think their retirements would turn out exactly the same. They both started with a cool $1 million. They both invested in the very same S&P 500 fund, and they both planned to withdraw the exact same amount of money every year. But the result? Well, Alice lived a great life and left a ton of money behind, while Bob went broke before he was 80.
So you have to ask, how on earth is that even possible? Same money, same investments, same spending. What gives? Well, the only thing they did differently, the one little variable that changed everything, was the year they decided to punch the clock for the last time.
And the answer to this whole puzzle, it comes down to a risk that most of us never even think about until it's way too late. It's called sequence of returns risk, and it's the invisible force that decides whether your nest egg survives retirement.
Here's the key takeaway. It's not about your average return over, say, 20 or 30 years. What really matters is the order in which you get those returns. Having a few bad years right at the beginning of your retirement is an absolute disaster, compared to having those same bad years later on.
You know, for our whole working lives, we're trained to just focus on that average return. But the day you retire, that mindset goes from being smart to being dangerous. Let's dig into why the very strategy that helped you build your wealth can actually be the thing that destroys it. See, when you're working and saving, a market crash is kind of your best friend, right? You get to buy up stocks cheap. That's dollar cost averaging working its magic. But the second you retire, the whole game flips upside down. Now, when the market drops, you're forced to sell more of your shares just to get the cash you need to pay your bills. It's called reverse dollar cost averaging, and it is a brutal, brutal way to lose money.
The formula for disaster is terrifyingly simple. You can handle a volatile market, and you can handle taking money out of your account. But when you mix those two things together, when you're forced to sell into a downturn, you create a toxic cocktail that just poisons your portfolio's future.
And this really gets to the heart of it. You don't live your life on an average. You live through the actual ups and downs, year by year. And if those downs are really deep right at the start of your retirement, that average return number becomes completely meaningless. You just won't have enough money left to benefit from the eventual recovery.
Okay, I know this sounds pretty bleak, but let's make it real. We're going to run a simulation using actual market data to show you just how powerful and devastating a bad sequence of returns can be.
So here's our setup. We have investor A, who retires in the year 2000, right as the dot-com bubble bursts. And we have investor B, who retires with the exact same annual returns from the S&P 500, but we're just going to flip the order. They get the good years first. Remember, same starting money, same withdrawals, same average return. The only thing that's different is the timing.
For investor A, it's a complete death spiral. The market crashes in their first few years, forcing them to sell their investments at rock-bottom prices just to live. Their portfolio gets smaller and smaller, so when the market finally does recover, the gains are applied to a much smaller base. It's like trying to fill a bucket with a hole in it. They can just never catch up.
But now look at investor B. Those amazing market returns in the early years create this massive financial cushion. Their portfolio is growing way faster than their withdrawals are shrinking it. So by the time the bad years roll around later, it barely even makes a dent. They're basically bulletproof and end up with even more money than they started with. It's incredible.
All right, so that was the scary part. But here's the good news. This is not something you just have to leave up to luck. You can absolutely defend against sequence risk. So let's talk about how to build a defense plan.
So financial planners have a name for this period. They call it the red zone. It's those 5 years before you retire and the 5 years after. And why is it so dangerous? Well, it's because your portfolio is likely at its biggest point ever, right at the exact moment you flip the switch from putting money in to taking money out. A big hit here hurts more than at any other time in your entire life.
And you have to understand the brutal math of coming back from a loss. If your portfolio gets cut in half, a 50% loss, you don't just need a 50% gain to get back to where you started. Nope, you need a 100% gain. And trying to do that while you're also taking money out to live on, it's pretty much impossible. The real game is to just not dig that hole in the first place. So, how do we do that? It really boils down to two main strategies. First, you need a buffer so you're never forced to sell when your stocks are down. And second, you need to be flexible with your spending so you can react to what the market is actually doing.
Now, the most popular way to build that buffer is something called the bucket strategy. It's actually pretty simple. You have bucket number 1, which is just 1 or 2 years of your living expenses in plain old cash. If the stock market tanks, who cares? You don't sell a single share. You just live off your cash bucket and give your investments time to bounce back. You've broken that poisonous link between a bad market and your income.
I know what you might be thinking. Keeping all that cash on the sidelines feels wrong, like it's a drag on your returns. But you have to change your perspective on this. That cash isn't an investment, it's an insurance policy. You're paying a tiny premium, the gains you might miss out on, to insure your entire retirement portfolio against a catastrophic failure. It's a trade worth making every single time.
The second line of defense is just being flexible. Instead of being super rigid and taking out the same 4% every single year, you adjust to reality. If the market has a terrible year, maybe you put off that big trip to Europe, or you just skip your inflation adjustment for a year. All the studies show that even tiny, temporary cuts in your spending can make a massive difference in whether your money lasts a lifetime.
You see, all of this really comes down to a huge mental shift. To succeed in retirement, you have to completely change how you think about your money. It's a whole new ballgame with a totally different set of rules.
This quote just nails it. The game isn't about chasing the highest returns anymore. It's not, how do I get richer? The new game is, how do I make sure I am never a forced seller when the market is down 30%? That's it. That is the only objective that matters from here on out.
So, let's wrap it up. What are the big things to remember? First, the order of your returns is everything in retirement. That old average return number, it's basically an illusion. Second, you have to protect that red zone, those critical years around retirement. And you do that with two things: a cash buffer so you never sell low, and a flexible spending plan so you can adapt.
And I'm going to leave you with one final question to really think about. I want you to stress test your own plan. Seriously, if the market gets chopped in half the day after your retirement party, what is your step-by-step plan? If you have a real, concrete answer to that question, you're well on your way to a secure retirement.